understood was for the modern products and banking?
Okay, so that's a great question, and it's key to the book. So if you think of like the 1800s and the 1900s to the 2000s with U.S. banking, the old banks in the 1800s and the 1900s, and even much of the early 2000s, banks were partnerships. So in other words, they weren't public companies. And the best thing about partnerships is imagine like you and I and 50 other people owning the bank. And when there's that kind of ownership level on a high level from many different people within the bank, the way the bank is run in terms of risk management, in terms of board selection, is just head and shoulders better than a public institution. Once a company goes public, like a public bank, most of the equity is owned by shareholders around the world. As you see today with passive management like BlackRock and Vanguard, you know, this passive revolution that's taken place over the last 20 years has really destroyed corporate governance because you have shareholders that don't really have a seat at the table. So when you go from a private bank that's a partnership, that's the way Lehman was run for over 100 years, and then you go public, and then your board is selected by the CEO. There's very little accountability. Whereas if it was a private institution, a bank that was controlled by 50 people, where you and I are major holders, then everybody has a huge skin in the game, and they're going to be a lot more careful around risk because it's their money.
So in that aspect, saying that, I believe this also, if we can apply it today to the modern understanding as well from the entrepreneurship and the smaller businesses, it's always, as you said, head to shoulder work, which includes communication that is very clear and transparent between the different parties. And maybe that's why one of the reasons that leads to the success. But in larger organizations, like, for example, let's mention our bank and other banks that are holding different and thousands of employees, how would that be part of a success to change a culture or an understanding to deliver the overall connection between the top management and the members who are eventually to deliver the vision?
Well, the board needs to be held accountable. So the board has to have skin in the game. A lot of these boards you get paid $400,000 a year, and then you go to the golf course. So that's one thing. There's not, if you have a board that's accountable to failure or has some downside. Now, in terms of communication, once again, if the CEO is also the chairman of the board, he controls the board, he controls the executive committee. The executive committee is selected by the board, right? And so you could easily create two silos where the board and the executive committee and the CEO is controlled by a few people, and they don't allow a lot of critical thinking. Like Madeline Antonczyk was our head risk manager, and she was kicked out of risk meetings in 2006, 2007. So they treat the risk people like operations. And what blows my mind is this actually happened with Credit Suisse last year with Archegos, where Archegos, we used to call it, this is kind of a joke, but, and I said this publicly, but we used to call it Goldman penis envy. Okay, so, and this is an interesting story. So Archegos wanted to compete just like Credit Suisse, just like Lehman wanted to compete with Goldman. So Lehman was the fourth largest investment bank, and Credit Suisse is probably number 8. So everybody's trying to compete with Goldman and the big boys, so they're taking more and more risk. And what happens with like prime brokerage, what almost brought down, you really look at this situation with Archegos could have taken Credit Suisse down. Nobody's talking about it, but from what I hear behind the scenes, this could have been really ugly. And Credit Suisse allowed Archegos and Bill Wang to roll the dice and use their balance sheet and do all kinds of crazy things. Goldman never would have allowed that. But in order to steal market share, Goldman penis envy, they were the Credit Suisse risk management team was looking the other way. The prime brokerage people were really ignoring risk management and letting a client, just basically have free reign over their balance sheet, right? And then so that happened over the last year, which is crazy. All these years after Lehman, it's very similar with Lehman, where Lehman was securitizing products, and we had these great businesses below that were originating loans. We owned BNC and Aurora Mortgage, and so we were basically selling loans around the world, around the country, and then securitizing them, and then moving them off the balance sheet. And what was happening is, as long as you're moving the product on and off the balance sheet, it's fine. Once things slow down, then there's risk. But Lehman was taking, much more risk than Goldman, because they're trying to compete with Goldman. They're doing, more aggressive things. Same thing with Credit Suisse. And so in terms of communication, I guess you need to have an executive committee with people that have big stakes in the bank and shareholders within the firm that have big stakes in the bank. If the firm is controlled by BlackRock and Vanguard and a whole bunch of shareholders that are some around the world, they just don't have the financial acumen to manage the risk.
I see. So from what you have just said, Larry, do you think that silo could be diagnosed in an earlier stage and then could be measured of the risk that it's going to be driving forward? And what could be such symptoms that indicates that we are in silo danger, and accordingly, we should be expecting in a period of time that this is going to fall back into a reaction?
Well, one of the things is Lehman had 4 CFOs in 4 years, right? And South Africa just went through a period of financial crisis of management where they had 4 finance ministers in 5 years. So when you have a lot of turnover at the CFO level, it's a sign that the management team it's a sign that behind the scenes, a lot of times the CFO, like I think this Mark O'Mara was his name. O'Mara was one of our CFOs. He was highly paid. What I heard is that he was not comfortable with the way Lehman was reporting their financials, because we were doing what's called Repo 105, and so we would basically do a large repo, bring assets on the balance sheet, and when we reported earnings, we would show we would do a repo before the earnings, so take assets off the balance sheet, report less leverage, and then bring back through a repo after the earnings. And so that was called Repo 105. And we had 1 or 2 CFOs that weren't comfortable with that and resigned. Meanwhile, Ernst & Young signed off on it through Linklaters in London. So it was an extremely aggressive accounting practice that when I was interviewed by the Financial Crisis Inquiry Commission, they were in Washington. I was interviewed by them, and they were just blown away that, number one, the board and Ernst & Young approved this Repo 105. It was just disgusting. Taking $50 billion before earnings, moving it off the balance sheet, reporting the earnings, and moving it back on. So one of the warning signs there was the looking at the CFO change there, and then the amount of footnotes on the 10Q and the 10K. One thing that investors tell me globally, some of the people that were short Lehman stock, Lehman was putting a lot of the amount of footnotes that were on the SEC filings from 2004, 5, 6, 7 were expanding. So a lot of footnotes is an indication of obfuscation, right? So it's like footnote, it's like something you don't want to say clearly. You have to put a footnote, and so Lehman was doing a lot of these things. And the other warning sign was, oil spiked in 2008, and that triggered a lot of mortgage resets with interest rates in the United States, because oil went from 2007-8 went from like 100 to 140, and interest rates, we were in an inflationary period in the United States, interest rates went very fast up. All these mortgages in America had to be reset, and there wasn't a lot of analysis in terms of risk management, in terms of a analysis around, okay, what if interest rates move up 3% in a 1 or 2 year period? Like, the balance sheet wasn't tested for that type of an event.
So Larry, what you're saying is really interesting, and it actually has triggered some kind of a question in my mind that if the management have seen that much of changes, and two CFOs have resigned with a lot of like footnotes, as you have also mentioned, how did that impact the lower level of employees? Did that leave any kind of residue of such actions?
Well, it did, and that was another warning sign, because Gelban, now remember, Mike Gelban now runs Exodus Point, and he co-ran Millennium with Izzy. Mike was pushed out of the firm with Alex Kirk in the very early 2007. So not only did we have CFO turnover, but we had key lieutenant, like general type people that were being knocked out of the firm. And, Mike, well, we learned later, and I spent a lot of time with Mike, and when I was writing my book, we learned later that Mike was extremely uncomfortable with the origination process of BNC and Aurora. So BNC and Aurora were mortgage companies, and they were originating like thousands of mortgages a month, like 10,000, 20,000 mortgages a month. And those mortgages would come onto the Lehman balance sheet, we'd securitize them and sell them. And Mike saw this in 2007 and was like very uncomfortable in the first quarter, late 2006. And he said, if we can't move this product at this speed, it's going to build up on the balance sheet, and we're already 40 times levered. The other warning sign was Lehman was about 40 times levered. So, and in the previous years, like the decade before, we were probably 25 times levered. So Lehman was taking the leverage up, and then that leverage was making very senior people more and more and more uncomfortable, to the point where Gelban and Kirk got pushed out or left the firm in the first quarter of 2007. That was another warning sign.
Right. So from that warning sign, and from as you mentioned, because this is really important, that it's not just only about the board, that there are also key people that are a reason of a success of not having this breakdown. So saying that, are we indicating in here a culture issue that could be raised? And did that culture was flagged, or was this culture tried to be highlighted for a solution? And if so, how did you guys at that time think of a best approach for it?
Okay, so once again, you kept your head down, you did your job, or you lost both. In other words, everybody was being paid so much with stock and options, and if you were to raise risk concerns up the board, you were neutered. So the culture was risk-taking. The risk management team was laughed at and not respected. The balance sheet was getting more and more aggressive each year, and anybody that spoke up was really silenced and pushed out. So it was a culture of risk. It was a culture of really aggressive management, where the CEO surrounded himself with a bunch of yes men, and then they spent a lot of time on philanthropy, and so Lehman was voted like one of the best places to work in 2006-07, and they had an art collection on the 31st floor. It was a very, imagine the 31st floor of Lehman Brothers. It should have been a risk management epicenter of a bank that's sitting on $1 trillion of risk. Instead, it was a group of people that were spending a lot of time on philanthropy, a lot of time on good social causes. But they weren't real financial people. Believe it or not, it's hard to imagine this, but the real financial brain power was on the trading floor, and the management team and the board was just off in another world, like really not world-class financial people. And the world-class financial people that they had, like Gelban and Kirk and McDade, were all kind of neutralized.
So that's really a powerful note that you put in here, is that maybe we're indicating also that the capabilities were not correct. And accordingly, they were not placed in the right place, and that probably led to further damage.
Yes,
But
and it led to further profits too. So that aggression in 2004, 5, 6, 7, 8, like Lehman profits exploded higher. And David Einhorn of Greenlight Capital saw a lot of this. And, you know, another warning sign was some of the questions on the conference calls in 2007, where Einhorn's analysts are asking questions and the CFOs weren't really qualified. Like the CFOs of Lehman became less and less qualified. Erin Callan's a nice person. She was our last CFO, but she was highly, highly unqualified for that job. And to this day, she never worked again really on Wall Street.
Oh, wow. So from taking all of this, it makes me wonder, where was some of the divisions and parties within Lehman that was supposed to take some kind of a care action to prevent this? What was the situation like, just to imagine what was happening on the other side?
Well, so over the years, the bank was making so much money, and they were taking more and more risk. In the end, they had almost 33% of the net tangible equity of the bank was in 3 commercial real estate investments, which were very illiquid. So Coeur d'Alphonse, SunCal, and Archstone. So Coeur d'Alphonse was a big property in Europe. SunCal was a major property in California, and Archstone was a major property in some of the U.S. cities like New York and Chicago, and they owned lots of buildings. And so what happened was, at some point, it would be very difficult to, it's like trying to turn around an aircraft carrier, right? Where you own these illiquid, 35% of the net tangible equity of the bank was in 3 colossal illiquid commercial real estate projects. What they were doing is they were using the repo market and the short-term financing market, LIBOR. They were funding themselves with short-term loans to finance illiquid projects. So as long as the short-term financing markets were liquid and deep, Lehman could keep funding these very illiquid projects. You just can't sell Archstone, SunCal, and Coeur d'Alphonse in any kind of reasonable period of time. And so by putting that much of the bank's net tangible equity into 3 very illiquid instruments, and then trying to have what's called a maturity mismatch, where you're long the illiquid, and then you're funding it in a liquid market, but if that liquid market dries up, then you can't finance this. That's what happened. And in the end, they could have, but oh, by the way, Lehman in 2021 never would have gone bankrupt, because our central bank and treasury have been allowing $1.5 trillion a day of repo transactions. So back then in 2007, Lehman needed to finance their overnight commercial paper, their short-term financing, their repo transactions through places like JP Morgan and Jamie Dimon. So Jamie Dimon had like incredible control over Lehman, because Lehman needed Jamie and these big banks to finance these big illiquid assets. Today, if you can go to the Fed, you don't need Jamie to some extent. So in some ways, Lehman never would have failed today, because what they've allowed over the last year is what the Fed has been doing, and we talk about this. So we run a live chat with about 650 right now in the other room, institutional investors. So it's like almost $1 trillion of assets in our chat. So it's a live chat on Bloomberg and if we're welcome to invite you folks in the chat, one or two people, or whoever's on Bloomberg. But one of the things that people are talking about in the chat this year is that the Fed and post-COVID has flooded the market with so much liquidity that you can finance anything this year.
So Larry, from what you have been mentioned and regarding the situation that is happening in Lehman, and I've been hearing in different lectures that you've been given before and speeches, is that at certain points, it felt like there was no communication allowed between different units or different parties through the investigation of the cases. Would that connection of the communication, would it save the situation at that point of time, or would it not add much into it?
You're absolutely right. It was siloization of risk. So, like, what's crazy is over time, people really didn't realize. Like, I was on the trading floor, and we had, some brilliant people were trading high yield bonds and leveraged loans, and then other people are trading equities, and other people are trading commercial real estate. Other people are trading emerging markets. So we had all these silos. Everybody's focused on their silo, and nobody realized that the bank became like a real estate investment trust with an investment bank on the side. In other words, because of the lack of communication between the silos, the bank was taking more risk, and the bank actually became a totally different bank. And because of the lack of communication between the silos, people didn't even realize this. They were just too busy running their own silo, their own businesses.
Did that, in a way or another, create some kind of a competition internally between these, what we name them, silos functions?
Yeah, there was definitely like a competition where each silo wanted to take more risk, trying to compete and wanted to please the management team. In 2007, they were coming down on the trading floor. They were saying, take more risk, take more risk. So the risk-taking culture in 2006, 2007, I'll never forget when they said, because I ran a portfolio of loans and high-yield bonds, and we remember from the top down, they were saying, take more risk. And we ran our corporate bonds, but we didn't realize that the real estate people were taking more risk by holding very, very liquid assets. And we didn't realize at the time how financing those assets, how difficult it could be if the market turned against the bank.
So that's really indicates like an issue of the connection between the different parties and how they can maybe work together that could eventually develop and deliver what is the vision of Lehman at that time. So to talk specifically about this, maybe take risk, what was indicated to the different parties playing in Lehman. Was this a direction from the, let's say, management to move forward? Was the vision from the management side and the approach for Lehman clear to everybody, or was it unclear that led to such actions?
Well, the culture was so like mob-like in the sense that, and this is what happened to Gelban, right? So Mike Gelban in the fourth quarter 2006, Mike ran fixed income. He's on the executive committee. He sees what's happening in the mortgage side. So there is some communication between the high-level people, and Mike started to speak up, and they basically pushed him out of the firm over a lunch on a Wednesday, afternoon. So Mike called a meeting with Joe and Dick Fold, Joe Gregory and Dave Goldbart, and Mike basically said, listen, I don't, there's a group of us that don't like this, what you're doing with the commercial real estate, the mortgages. And they said, Mike, you've always been too cautious. you probably, this bank probably isn't for you. So if you spoke up, if one head of one silo started to complain about the other head of a silo that was making a lot of money, they would put essentially a bullet in the guy's back.
To put him to sleep.
Just like a mob, yeah, put him to sleep.
Yeah.
I don't know if you ever seen The Sopranos, but it's just like that.
Yeah. So Larry, saying that, it indicates really some kind of an unbalanced culture that was a bit very difficult to be in. How was the everyday for the employees and staff of Lehman, if this was all happening in a larger scale of management?
Well, that's the thing. Everybody's making $1 million, $2 million, $3 million. I mean, bond salesmen. I knew bond salesmen that were making $1 to $2 million a year, and they have the house in Westchester with the kids and the dog, and some guys are in their second divorce. It's just and you're making that much money, and your family's leverage, and people just shut up and just everybody was complacent around money and how much money they were making. They were getting paid in what we called later as Confederate dollars. In other words, this Lehman stock they started printing more and more stock to pay bonuses. So you were being paid with a depreciating currency in the sense that they were just like printing more and more stock to pay bonuses. Everybody was getting paid huge bonuses. And it's very difficult for, some analyst in equities that's making $1 million a year, or some salesperson in high yield to stand up to these guys when they're making that much money.
So are you indicating in here that the incentive could sometimes be improper approach for rewarding? Could the incentive create a negative culture?
I'm sorry, could the incentive what?
Could the incentives create a negative culture? Could it deliver or drive the people to the wrong side of the strategy and the vision that was supposed to be delivered? And accordingly, as we mentioned, that this is where the silos hitting. Exactly.
And that's why Mike Gelban's such an amazing guy, because he's like one of the few people, he and Kirk, out of all the people, were willing to basically, when Mike Gelban went up there and said, and was making a stand against the mortgage department and making a stand against commercial bills, he was basically walking away from a job that paid him, $30, $40, $50 million a year. So imagine walking away from that kind of money. Maybe it's 20 to 50 million. So anybody that would, you're right. People were incentivized to keep quiet and to just play ball. Whereas the revolutionaries, anybody that stood up to the mob within Lehman was basically giving up tens and tens of millions of dollars, anywhere between 10 to 50 million. Imagine walking away from $50 million a year. Not many people would do that.
That would be lovely. Yeah, that's harsh. So, Larry, if we want to summarize and highlight what was specifically the main issues beside the financials of how the strategy or how the culture or how the members of Lehman was practicing, if we want to extract what was the main issues from that aspect, what can we list them as?
Well, first, remember, we were the fourth largest investment bank, and the other banks had deposits. So the whole culture of the street was like Lehman was incentivized to take, like JP Morgan, Citibank, they had 3-4 trillion of deposits. So their balance sheets were very strong. Whereas Lehman and the other, Bear Stearns, the investment banks, Goldman didn't have any deposits. So they were incentivized, like Lehman was 40 times levered and JP Morgan was 18 times levered. So Lehman needed more leverage to compete with the big guys. And so within Lehman, that was understood and that was accepted.
Was Lehman separated into groups? Because I remember, if I wasn't mistaken, in one of your speeches, you did mention the Bears and the Bulls, two different groups that were leading into Lehman.
Yeah,
Is
over
that an
time,
issue?
yeah, over time, there was a group of revolutionaries that were in fixed income, and it was Larry McCarthy, myself. There's a whole group of people, Alex Kirk, and that was one faction that started to get very, very, very uncomfortable. And then there was these other factions that were in real estate, commercial real estate, mortgages that were just kind of, they were basically betting that, you know, globalization was going to keep the bank moving. The bank had diversified a lot of assets around the world. That's why they owned Cour de France in Europe. So the feeling was that even though we were levered, the bulls within the firm believed that we had enough global asset diversification. But what they didn't realize, and this is so, it all comes down to financing, because it's just, people just didn't understand how difficult it would be to finance illiquid assets.
So if I would drive you back, Larry, in time, and we would have said, if we can play differently for Lehman at that time to save Lehman, what would you say could be done to prevent such a situation?
You would have to have a coup d'etat that would have taken out Fold and replaced Fold and the board with a group of people that were, you know, much better risk management people. So that would have required, I mean, that would have required a lot. I mean, I don't know how we could have pulled it off. The other thing would be to de-lever the balance sheet earlier. So by the time they realized that the iceberg was off in the distance, it was too late. So when you see the iceberg, and the original title of my book was "Even the Titanic Swerved," but when you see the iceberg off in the distance, and you're moving at a certain speed, you need a certain amount of miles to get around the iceberg. And so if somehow Lehman delevered in 2005, 6, instead of trying to delever in 7, 8, they would have survived. So what I mean by delever is sell assets. So if they tried to sell Archstone in 2006 or early 7, they probably could have got a good price for it. So that would have delevered the balance sheet. Same thing with SunCal. Those are the things that could have saved it.
What about the people? Could the people be part of saving Lehman at that time? Because you did mention before that there was some kind of a culture of whether keeping your head down or you're out of the game. So what if the people at that time stood up and spoke up? Would that have changed really the game and the consequences that happened to the Lehman?
Well, that happened. Gelban stood up, Kirk stood up, Mark O'Mara, the CFOs quit. So there was a bunch of people that stood up and they were just shot. So when the board has that kind of control, when the CEO has that kind of control over the board and the executive committee, Madeline Antonzik stood up. She was the chief risk officer. She was pushed out of the room. So everybody that I know from, I think it was Chris O'Mara, Madeline Antonzik, Gelban Kirk, Larry McCarthy. I mean, there's like 10 people stood up and they were all pushed out of the bank.
Wow, that's really harsh to hear.
Yeah.
But but Larry, I mean, Thank you very much for this. I want to also to give our audience some time to also take some questions, because I think we have people that want also to participate. If you would allow us to start with that.
Yeah, and I just say in closing that today, we've gone through Lehman and now COVID, and a lot of that leverage has been transferred from the banks to the sovereign countries and government debt. So we've gone from levered banks and Lehman to now governments. And the amount of leverage, there's an extra 30 trillion of debt today that's below 2%, that's on government and like some corporate balance sheets, like corporate bonds, government bonds. And now the leverage is so much greater that like the United States is 30 trillion of debt. So 1% move in interest rates up is 300 billion of extra interest costs. So in some ways, the next Lehman is on the government side. Now the central banks are trying to suppress yields over the last number of years, but the slightest move up in bond prices and bond yields now, like 1% move up in bond yields is like 5% 20 years ago. 25 basis points is like 1%. 1% is like 4 or 5%. So we're coming into a period where hard assets like oil, copper, all the natural resources, those are going to be the places where capital is going to flow to, whereas the previous decade was a deflationary decade where growth stocks and bonds did very well. Now we're coming into a period where commodity. I think banks like yours could be in a good position.
We're praying for that.
Yeah.
All right. So for the audiences that we have, I think maybe we can raise your hand, or if you can just open your mic and put your questions.
Larry? Yeah, a small question actually from the past experience and from the information that's been provided by you.
You're muted.
Can you hear me, Johar?
Yeah, I can hear you, but maybe might be able to need some help on understanding the question, but I can hear you.
Yeah, okay. Let me repeat the question. Actually, back from your previous experience on this situation, and from the information that's been provided by you during the past 15 minutes or 20 minutes, I need to know exactly what is your advice to reduce the silo and improve the communication. I mean, what is the best scenario in order to reach to that level?
Okay, so the management team or the executive committee of a bank needs to hear from the top 3 or 4 lieutenants of each silo every quarter, independently in a private room without anybody else. So there's no intimidation. That would be the first. I mean, the way it was in Lehman is if you spoke up, you were intimidated. Now, the board also should have one-on-one meetings with the heads of each division and not have the CEO in the room. So the CEO and chairman of the board, that has to be split up. And the board should listen to the head risk people or the head of each division, the top 10 officers, the top 5 of each silo, with independence, without intimidation. I think that would be the one thing that would be most effective.
Communication or effective communication to increase the, let's say, efficiency and etc.
Yeah, effective communication without intimidation between the board and the top 3 or 4 officers of each silo, and also create an incentive for a reward incentive, financial monetary reward incentive for people that come up with valuable information. So there's a term for it, but right now the SEC has the whistleblower. So right now, if you go to the SEC with information about a company or financial institution, you can collect millions of dollars from the SEC. There should be that type of reward system within a bank from lower level people. Now, you're going to hear some crazy complaints from time to time from people that are not valid, but if you have a real incentive program where your financial monetary compensation rewards people that come forward, whistleblowers, that's another very good idea.
I think that's really interesting. I didn't come to hear of such an advice before of incentivizing whistleblowers, because I could imagine, like, could that somewhat drive to a different kind of a view if we do, let's say, incentivize whistleblowers, if we allow this? I mean, I know that every organization or every company would have some kind of a risk rules to abide, but I mean, this is really interesting to hear that this could be a suggestion coming for
Well, see,
incentivizing and encouraging
so
this
think
move.
about Madeline Antonzik, right? She was a PhD economist. I had dinner with her 15 times in New York, but when I was writing the book. But I spent a lot of time with her. I think she's now in Australia. I mean, we went out for dinner, and we had a lot of wine, and she told me everything. And what happened is when Madeline she was a whistleblower, and she complained, but she complained to Dick and the board, or Dick and the executive committee, and Dick just said, "Oh, he kicked her out of the room." Whereas if the board, if she could have just spoken to the board or just spoken to the executive committee by herself, then her whistleblowing actions would have been taken a lot more serious.
You see the connection between connecting the board directly with the lower level of maybe Dex to Madeline directly would have been saving probably a lot of the headache.
Yeah, and Madeline was like, she wasn't just some run-of-the-mill employee. I mean, she was the chief risk officer of the firm. So she wasn't allowed to, like, talk to the board one-on-one. It's absolutely crazy. And the board was filled with, like, 75, 80-year-old people. With Dina Merrill, who was a former actress. We had an admiral from the U.S. Navy on the board. I mean, this is absolute madness. So you had the board that's not qualified, don't know anything about 21st century financial products. And the chief risk officer isn't allowed to talk to the board and educate them on what's in the balance sheet. Well, it's complete stupidity.
If you allow me, Larry, is
Yes.
it agility methodology or high-tech system one of the solution for breaking the silo and communication in your point of view?
Can technologies break the silos? Is that the question?
Yeah, I mean, is it agility and high-tech technology methodology one of the solution to break the silo and increase the communication between the people inside one organization?
Well, in terms of modeling risk, the VAR models and technology, that all proved very ineffective. Like, models were like backward look. All the risk models didn't work for a whole bunch of reasons, which I can get into. But in terms of technology breaking the silos, I guess maybe if you had a communication system where you could anonymously communicate complaints or risk management suggestions, maybe even anonymously into a system where the board or the executive committee would review those. I mean, I don't know. It's just something to protect the person that is making the claim. But in terms of technology, I can't think of any.
But I do remember, Larry, if you would allow me, from our discussion earlier, that we've been mentioning that because the different units were focusing specifically on their target and moving forward without looking of what is the other side is happening, was one of the damages that cost Lehman this much of loss and eventually to the level it reached. So I believe what maybe our colleague in here is maybe trying to say is that if there was some kind of a system that could have viewed of what is happening in the different silos between the different units, maybe it could have triggered and flagged that instead of moving into an action, you need to understand that the other side of it has been already moving into another action that may be a damage if you move forward with yours.
That's a good point. So if you had a risk management system that allowed an overview of the risk of each department with clarity around the leverage of each department, balance sheet, how much each silo of the balance sheet was being used by each silo. If that was broken down in a clear way and through some type of model that the top executives could see, that would be helpful. Now, remember, we did have financial statements. We had 10Qs and 10Ks, and we had annual reports, which were supposed to do those things, which were very, very unclear financial statements. Like I said, Repo 105 was a fraud. So when the company was about to report their annual, I guess the 10K, which is the 10Q is the quarterlies, and then 10K, and all the top officers are supposed to just to read all these documents, and they're supposed to look at them online, and there's definite technology that creates these documents. There wasn't a lot of clarity within those documents, so you'd have to have crystal clear look at risk. That was very, very, more clear and more breakdown risks so that anybody can read it.
Was there any kind of a rewarding, beside the incentives that you mentioned, Larry, was there any kind of a rewarding kind of a technique for members for innovation, or something that maybe could have connected the other silos together, like approaching with an idea of how we can maybe leverage in a system, maybe leverage in a different approach for the balance sheets that was distributed between you and the other units? Was there anything like that, or was that not in there? And what about also the training? Because you've mentioned also that there was a lack in the capabilities of the hired people. Was training part of the concentration areas that they wanted to push into the unskilled people to make sure that the gap is a little bit bridged?
Yeah, there was no training. So if you were in high yield or equities or emerging markets, your knowledge of commercial real estate and leverage, even if you're very smart, would be fairly limited. So the sophistication within each silo is pretty significant. Because if you're head of fixed income or head of high yield, you're a senior managing director, do you really understand how much balance sheet the commercial real estate group was using? Now, there were some people that figured it out, like Gelban and Kirk and Madeline, but yeah, there wasn't a lot of, one thing you could do is you could get everybody together in these meetings. So the senior managing directors would have an annual managing director meeting where senior MDs of each silo would get together, Hawaii, whatever, or some ski resort. And they did have these events where there would be breakout sessions where the different heads of the silos would talk, but it was more like, a boondoggle where you ski it, maybe a day is tour skiing, some golf, whatever. You have some meetings and you do have some presentations where they are breaking down. These things did happen, but at the end of the day, the real communication level of risk management to the greater level employees wasn't there.
And why specifically this was not there, despite all what you have mentioned? Because this really sounds like a very great initiatives done to break the ice between these silos and connect them together. But why that did not happen despite the effort? What was really like the issue behind this miscommunication?
So I made an appearance in Inside Job, which won the Academy Award. And what I talked about there was that the senior management team they had a deep, dark secret. They really didn't want people to understand that they didn't understand the risk. So they wanted to keep the silos separate and not they wanted that like Dick Fold never appeared on the trading floor. There was one day we made $260 million in one day, the biggest day in the history of fixed income, and he was a no-show. So like this, they literally wanted that separation so that they could have control. And once again, that goes down to the board. It all comes down to the board. If the board had younger people that had real financial experience, and the executive committee had a connection with the board without intimidation from the CEO, all the problems would have eventually gotten up and been communicated the right way. Instead, you had like a blockade between the board and the executive committee and then the silos. So you've got the silos, that's the head of each, 20 silos. You got a senior managing director at the head of each division. And then you have the executive committee, which is like 8 senior guys, maybe 1 or 2 women, and Madeline and Tonzik's part of that, supposedly. And then you have the board. So those are your 3 big ones: board, executive committee, senior MDs. And they were all separated.
This is Mohammed Shaiban. How are you? Hi, Larry.
Hi, thanks so much for being with us.
Thank you very much. Larry, I do have 2 quick questions, please. First question, both the financial crisis and the collapse of Lehman Brothers, there were many street surveys being conducted covering the old Lehman Brothers employees. Okay, the results was very interesting. It declares that the staff, over a period of time, they didn't feel any moral, closing to the bank. Can you just please, if this is correct result, can you just elaborate more about this from your close exposure to the Lehman Brothers?
Okay. Ibrahim, could you give me your analysis of that question? Ibrahim?
Yeah, so it's Al Johar, but yeah, I'm using Ibrahim's screen. So So I believe, Hamad, if you can just quickly just repeat the question, and I can just give it to Larry in a different way.
Yes, there were many survey done covered Lehman Brothers people after the collapse. The result that those people they didn't feel a moral in the closing to the Lehman Brothers. So that was one of the main factors led to the collapse and created the silo inside the banks. If you can just elaborate more on this.
Do you want me, Larry, to repeat that for you
Yeah,
in a
like
different
what's
way?
your view? Yeah, I like.
All right.
I really like your perspective. Like, what's your view of that point?
Yeah, so what basically Muhammad was indicating is that part of the analysis we were running through of what happened to the Lehman was a survey that was shared between the different staff for Lehman. And the responses back is that maybe because of the incentive, they were not feared enough that whatever actions that they were taking, specifically working in silos, not looking at the other damage from the other side, that maybe was the reason to lead of that much risk taking to move forward with further actions, because that incentive was more of an appetite than actually what could happen eventually to the organization itself.
Yeah, that's a key point. So when you're head of high yield, or if you're head of equities, you're head of emerging markets, leverage loans, you've got an incentive to make your P&L for that group. Each one's like a separate business, and there is no financial reward for, like, your financial compensation is 100% related to your performance of that group and your bonus and your incentives. So if you're head of high yield, you're going to trade bonds, you're going to position bonds, you're going to do banking deals. And so your entire compensation platform is designed around that silo. And you're right. There's no, if there was a financial compensation, that gets back to the whistleblower. So if you had a reward system for people that would actually help the bank manage risk better, now that's Madeline Antonzic's job, right? She's the head of risk management for the bank. But maybe if there was like a reward system from the different silos where the head of high yield could make risk recommendations or suggestions to, say, to Madeline about maybe the head of commercial real estate. And if there was more financial compensation based on, risk management and whistleblowing, or that would definitely be something that would break apart the silos.
Final question from my side. Sorry,
Go ahead,
Tahara.
Mohammed.
Just
Yeah, I just
quick
wanted to
question.
comment on this.
Yes,
But
Joe. Go
basically,
ahead.
just on the same question that you have just mentioned and regarding Larry's answer, it seems between the lines I'm hearing that it's not just about that, maybe about Madeline's situation, how empowered and delegated are those C-level to take the actions without coming back to the board? Was there any authorization from their side to move forward? Or because I'm hearing that every time that they needed to come back to the higher level of management for any changes or so, but was there any delegation of authority for them to take that action?
Yeah, no, so the way it worked was, if you're a managing director in high yield, you could go up to your boss, and I had a direct line to Gelban. So I wasn't allowed to, if I discovered anything, I'm not allowed to go from, if I was a senior managing director in high yield, or I'm not allowed to go and communicate in any way about risk to the head of commercial real estate or the executive committee the reporting line is I have to go up to the head of the silo, and then it's his job to take it. So there was no break. It goes a straight line. So, and if you veer off that line, you get fired.
Hmm.
So yeah,
Okay,
so
Larry.
think of the silos here. You could have a senior managing director in this silo, like a managing director in this silo, and these two really don't. It has to go up and then to the board. There's nothing, but they
Yeah.
can communicate, but there's no. You really you really don't make suggestions to other people about their businesses. It's considered like
Correct.
it was considered like bad taste or.
Yeah,
Hmm.
absolutely. Okay, Larry, suppose today is the September 13, 2008, just that one day before announcing the collapse. And Larry McDonald has the final call to take the final decision, but not, shooting the bullet of mercy. So what you will decide to take?
Okay, so George Walker was President Bush's, was on our board. I think he was on our executive committee. And think of like President Bush was Herbert Walker Bush, and then the H.W. Bush was the president. So George Walker and Gelban, they actually called the White House on September 13th, and they were trying to go around Paulson because Paulson and Jamie Dimon were basically just saying, you're going to have to liquidate. And so our George Walker, who was on our executive committee, made a call to the White House and to his cousin, President Bush, and President Bush would not take the call. So there were a lot of last minute attempts to come up with solutions. But at the end of the day, I think Paulson wanted Lehman to fail because he needed that in order to pass the TARP plan, which was a $750 billion plan. They never would have, that's the first vote in the House. It didn't pass. So it was almost a $750 billion bailout. And I think Paulson knew you needed Lehman to fail to get the capital to bail out the other banks from Washington.
Hmm.
Did that answer the
One
question?
more, Yes, thank you. One more question, if you allow me, Larry. Is there any kind of KPIs that will help and monitoring the silo or communication that will help from your past experience?
Is there any kind of what? I mean, I get the silo question, but like, is there any kind of a device or what?
Yeah, let me repeat that question again. Is there any kind of key performance indicators that will help to monitor the silo and communication and keep them in the right direction?
Okay, internally or externally? In other words, are there measurements for external investors, or is it you're talking about internal measurements between silos?
I think maybe we can, because that's interesting to that you guys are also measured from an external, but I'm not sure how the external probably would measure you from the performance overall of what profitability is coming back to them, but internally, because that could be creating the silos mostly.
Yeah, because the bonus pool. So each silo is a business. Think of it like a separate business, and it has its own profit It uses a certain amount of balance sheet, and it has its own P&L, and it has its own bonus pool. So that silo, everybody spends an incredible amount of time making that business as profitable as possible. And same thing with the other silos. And so there was no internal system that really, it was so competitive, and it was so, each silo was so competitive with the others that, everybody protected their own information. It was like Coke and Pepsi. Like they don't share, they really don't share a lot of secrets. To the head of the silos, that's the job. If you're the head of the silo, or that's the job of the board and the executive committee, is to look at everything from the top down.
That's really interesting what you have just indicated, because I was also thinking, looking at the different, let's say, because you're running as different businesses, despite you're under all the same umbrella, but exposing the data between the different businesses, would have that supported?
Yeah, if there was more transparency on the balance sheet usage of the businesses, and which businesses were putting the bank at risk, that would have been really helpful. Now, Madeline knew that, and it was Madeline's job to report that to the rest of the silos, Madeline and Tonzik, but she was neutralized. And it's very similar to what happened at Credit Suisse last summer. There were risk management people that were supposed to stop people like Archegos from exposing Credit Suisse investors and shareholders to that kind of risk. And once again, those risk management people were neutralized.
Lehman's experience, Credit Suisse, which you referred to, and SoftBank, what would be the common themes that come out to you?
Yeah, SoftBank is potentially a Lehman. SoftBank would have gone under during COVID if the Fed. I mean, SoftBank is just unfortunately, when you don't allow the business cycle to function over longer, and there's a cleansing process of the business cycle, right? The business cycle is supposed to take out the Enrons, the WorldComs, the Adelphias, the Al Dunlaps. Al Dunlap had a Sunbeam. These are bad people. There's always been bad management teams in every business cycle. Neutralizes the scumbags, right? Madoff was neutralized by the Lehman failure. When you don't allow the business cycle, when central banks don't allow the business cycle to function over long, the cleansing process is neutralized over longer and longer period of time. All you're doing is you're creating massive amounts of Dick Folds and Bernie Madoffs and Al Dunlaps. And there's just literally probably 10 Lehmans out there now. The central banks have not allowed, they have repo financing for any fucking piece of crap property or loan. You can finance any piece of SHIT. I mean, you can finance NFTs now. I mean, you couldn't, when you don't allow the cleansing process of the business cycle to function, you're just literally creating Jeff Skillings, Bernie Madoffs, Al Dunlaps, Dick Folds. And unfortunately, we're going to pay the price in the next, probably 18 months for this.
Right. So, do we have any other questions from our audiences? Or maybe we can put it in the chat.
can conclude, Johara.
All right. So, Larry, thank you very much for your time. This was really a very insightful session. Really appreciate you joining us and enlightening us in a lot of different aspects and corners. I hope that maybe in the future we can be connected into a solution for the silos that we've been faced. But overall, we really appreciate your time. Thank you very much. Thank
Okay.
you, everybody, for
And I'm on Bloomberg, and if anybody is actually managing risk or assets, please reach out to us on Bloomberg, and we can put you in our Bloomberg chat. Thanks.
Perfect. Thank you very much, Larry.
Thanks.
Thank you, everybody.
Thank you, Larry. Bye.
Thanks.
Goodbye.
Thank you.